The global silver market entered an atmosphere of extreme instability the moment institutional trading desks, sovereign wealth analysts, commodity hedge funds, bullion wholesalers, and macroeconomic research divisions simultaneously began circulating projections suggesting that silver could suddenly collapse toward the $76 region, a scenario that immediately triggered widespread fear across futures exchanges, precious metals, vaulting networks, refinery contracts, industrial procurement departments, and retail bullion channels because investors who had spent months believing that silver was protected by structural shortages, inflation anxiety, geopolitical fragmentation, central bank distrust, and accelerating industrial demand suddenly witnessed an aggressive reversal capable of destroying confidence at extraordinary speed, while algorithmic trading systems intensified the panic through relentless sell programs that accelerated volatility beyond levels justified by physical fundamentals alone, causing heavily leveraged speculators to face severe margin pressure, forced liquidation events, collapsing risk tolerance, and psychological exhaustion as liquidity rapidly disappeared from the market. While major bullion dealers across North America, Europe, the Middle East, and Asia reported unusual hesitation among physical buyers who previously accumulated silver aggressively during every correction, but now questioned whether institutional investors possessed deeper information regarding weakening industrial demand, tightening monetary conditions, stronger real interest rates, slowing global manufacturing activity, or hidden instability inside derivatives markets, all of which created a dangerous emotional environment where fear began replacing conviction, speculation replaced disciplined analysis, and long-term investors suddenly found themselves confronting the uncomfortable reality that even assets supported by powerful structural narratives can experience violent dislocations when leverage, sentiment, and macroeconomic uncertainty collide simultaneously within modern financial markets that remain deeply dependent upon confidence, liquidity access, and institutional positioning stability. As financial media networks amplified headlines surrounding the sudden silver collapse, institutional analysts shifted their focus toward the deeper structural vulnerabilities exposed by the crash because what initially appeared to be a normal correction increasingly resembled a stress event capable of testing the resilience of the entire global precious metals ecosystem, especially after bullion banks began reassessing derivatives exposure linked to over-the-counter metals contracts, futures obligations, hedge fund leverage, and counterparty liquidity risk, while physical silver distributors reported an unusual contradiction in which spot prices were collapsing aggressively, even though several regions continued experiencing constrained inventory availability, elevated premiums on deliverable products, delayed wholesale shipments, and persistent industrial procurement demand from sectors connected to solar infrastructure, semiconductor production, aerospace manufacturing, advanced electronic systems, military technologies, and electrification projects, conditions that confused inexperienced investors, because traditional commodity theory suggests falling prices should weaken demand and increase available supply. Yet the silver market historically behaves differently during major liquidation phases due to the separation between paper market speculation and long-term physical accumulation strategies pursued by sovereign-linked entities, industrial consumers, family offices, and wealth preservation institutions that often treat violent price declines as opportunities to secure strategic hard assets at discounted valuations, while mining corporations simultaneously entered a period of severe operational pressure, as declining revenues collided with rising energy expenses, labor costs, geopolitical permitting challenges, deteriorating ore grades, and debt-financed expansion strategies developed during the previous bullish cycle, forcing analysts to evaluate which producers possessed sufficient balance sheet strength to survive an extended downturn without restructuring operations, reducing exploration budgets, delaying production growth, or liquidating strategic assets, developments that reinforced fears that the silver collapse might evolve into something far more significant than a temporary market correction because prolonged weakness could eventually destabilize future supply growth across an industry already struggling to satisfy rising long-term industrial demand. The final and most psychologically destructive phase of the silver collapse emerged when investors across global commodity markets began confronting the central question dominating every major trading floor, sovereign reserve office, institutional research desk, and physical bullion network simultaneously. Namely, whether the violent descent toward $76 represented the complete destruction of the silver supercycle thesis, or merely the type of engineered panic historically associated with major accumulation opportunities inside long-term secular bull markets. Because futures data revealed extraordinary liquidation activity among leveraged participants whose forced selling accelerated downside momentum far beyond levels supported by underlying physical conditions, while at the same time premiums on several physical silver products remained unusually elevated despite collapsing paper prices, suggesting that industrial consumers, strategic accumulators, and long-horizon investors continued securing supply beneath the surface panic due to ongoing concerns regarding resource scarcity, geopolitical fragmentation, energy transition demand, sovereign debt instability, weakening fiat confidence, and future monetary debasement risks, all while central bank policy expectations remained the dominant macroeconomic variable influencing investor psychology as traders monitored inflation trends, bond markets, currency strength, employment conditions, and monetary policy communications for any indication regarding future liquidity conditions capable of either extending precious metals weakness or triggering an explosive reversal in sentiment, whereas retail investors suffered severe emotional capitulation after entering the market during the euphoric rally phase, only to witness rapid portfolio destruction accompanied by relentless bearish narratives across financial media and social platforms, creating a historically familiar environment in which crowd psychology shifted violently from greed to fear, while experienced institutional capital quietly evaluated whether physical demand resilience, tightening long-term supply conditions, and strategic industrial necessity would eventually overpower the temporary dislocations caused by leverage-driven panic and speculative liquidation inside one of the most emotionally volatile commodity events of the modern financial era. The silver market entered an even more dangerous phase once institutional investors, sovereign-linked commodity strategists, global bullion banks, and macroeconomic research divisions began treating the collapse toward $76 not as a temporary correction, but as a systemic stress signal capable of exposing hidden weaknesses throughout the global financial architecture. Because large derivatives desks rapidly reassessed counterparty exposure tied to leveraged metals contracts, futures obligations, and over-the-counter swaps, while hedge funds facing rising margin pressure accelerated liquidation activity across commodity portfolios, causing volatility to expand far beyond levels justified by physical supply-demand fundamentals alone, even as physical silver distributors across Europe, Asia, and North America continued reporting contradictory conditions involving persistent inventory tightness, elevated premiums on deliverable bars, delayed wholesale shipments, and steady procurement demand from industrial sectors connected to renewable energy infrastructure, semiconductor fabrication, military electronics, and electrification systems, developments that deeply confused inexperienced market participants who expected collapsing spot prices to immediately destroy physical demand, but instead discovered that paper market panic and long-term physical accumulation frequently operate according to entirely different incentives during major commodity dislocations, while experienced wealth preservation institutions quietly evaluated whether the emotional liquidation wave could eventually produce strategic acquisition opportunities, similar to those historically observed during previous periods of monetary instability, sovereign debt anxiety, and liquidity-driven commodity crashes that temporarily distorted valuation mechanisms before physical fundamentals eventually reasserted themselves across global hard asset markets. As the collapse narrative intensified throughout financial media networks and social platforms, the mining sector became one of the most vulnerable components of the broader silver ecosystem, because producers that expanded aggressively during the previous bullish cycle suddenly faced simultaneous pressure from falling revenues, rising extraction costs, deteriorating ore grades, geopolitical permitting complications, labor inflation, energy price volatility, and debt-financed expansion strategies developed under the assumption that elevated silver prices would remain sustainable for years, forcing institutional analysts to determine which companies possessed sufficient balance sheet resilience to survive an extended downturn without severe operational restructuring, production cutbacks, or exploration cancellations, while industrial procurement departments connected to solar technology, aerospace manufacturing, battery systems, advanced telecommunications infrastructure, and strategic defense projects continued monitoring supply availability carefully due to growing concern that prolonged weakness in silver prices could eventually reduce future mining investment and create structural shortages later in the decade, an outcome that would carry enormous implications for governments pursuing aggressive electrification and energy transition agendas, particularly because silver remains indispensable for conductivity-intensive technologies central to modern industrial civilization, while simultaneously, global central banks struggled to maintain stability inside broader financial markets as rising sovereign debt burdens, slowing economic growth, tightening credit conditions, commercial real estate stress, and persistent inflation. Uncertainty created an unstable macroeconomic environment in which precious metals volatility increasingly reflected deeper anxiety regarding the durability of the existing monetary system, rather than simple fluctuations in commodity speculation alone. The psychological damage inflicted upon retail investors during the silver collapse became one of the defining characteristics of the event, because millions of participants who entered the market during the euphoric rally phase had been conditioned by aggressive bullish narratives, sensational financial commentary, and unrealistic triple-digit price projections to believe that structural shortages alone guaranteed uninterrupted appreciation, only to encounter a brutal reversal that destroyed confidence with extraordinary speed as social media platforms amplified fear-driven predictions of prolonged bear markets, institutional liquidation cascades, collapsing industrial demand, and systemic weakness throughout the precious metals sector, causing many inexperienced investors to abandon long-term analysis entirely and capitulate emotionally at precisely the stage when professional capital historically begins evaluating strategic re-entry conditions. While institutional commodity strategists focused less on short-term headlines and more on liquidity dynamics, physical inventory flows, industrial procurement behavior, and sovereign reserve diversification trends. Because experienced market operators understood that the future trajectory of silver would ultimately depend not upon temporary emotional panic, but upon the deeper interaction between monetary policy expectations, industrial demand resilience, geopolitical fragmentation, mining supply constraints, derivatives, market leverage, and global confidence in fiat purchasing power itself, all of which transformed the collapse towards $76 into far more than a simple commodity correction, and instead established it as a defining stress event capable of reshaping investor psychology, precious metals positioning, and strategic resource planning across the international financial system for years to come. The final stage of the silver collapse emerged when institutional investors, sovereign reserve managers, macroeconomic strategists, and global commodity trading desks collectively began confronting the defining question dominating the entire precious metals market, namely, whether the violent descent toward $76 represented the permanent destruction of the silver supercycle thesis, or merely the type of engineered panic historically associated with long-term accumulation opportunities inside secular commodity bull markets. Because futures market data revealed extraordinary liquidation pressure generated by heavily leveraged participants forced to exit positions under tightening liquidity conditions, while simultaneously several physical bullion networks continued reporting elevated premiums, constrained inventory availability, and persistent industrial procurement demand despite collapsing paper market prices, a contradiction that intensified debate regarding whether derivatives-driven selling had temporarily disconnected silver valuations from underlying physical realities connected to renewable energy expansion, semiconductor manufacturing, military technology systems, advanced electronics production, and strategic electrification infrastructure, while experienced institutional capital quietly assessed whether the emotional capitulation spreading across retail markets resembled previous historical turning points during which panic-driven selling eventually exhausted itself and allowed structurally important commodities to recover aggressively once forced liquidation pressure subsided and confidence gradually returned to long-term investors capable of tolerating extreme volatility within financially sensitive hard asset markets. As global central banks continued navigating the unstable balance between inflation control, sovereign debt sustainability, slowing economic growth, and financial system liquidity preservation, silver remained trapped between conflicting macroeconomic forces because higher real interest rates, stronger currency valuations, tightening credit conditions, and weakening manufacturing activity created immediate pressure on precious metals sentiment, while long-term concerns regarding fiat debasement, geopolitical fragmentation, rising military expenditures, and declining confidence in traditional reserve systems simultaneously strengthened the strategic appeal of tangible hard assets, independent of sovereign liabilities, leading several institutional analysts to argue that the collapse towards $76 reflected not the disappearance of silver's structural importance, but rather the violent repricing mechanism through which modern financial markets remove speculative excess before establishing a stronger foundation for future cycles, particularly as mining executives warned that prolonged weakness could force reductions in exploration spending, delay expansion projects, and reduce marginal production capacity across an industry already struggling with declining air quality, energy cost inflation, regulatory obstacles, environmental permitting delays, and geopolitical instability in resource-rich jurisdictions, all of which reinforced fears that temporary bearish sentiment might eventually create severe long-term supply constraints. Once industrial demand associated with electrification, artificial intelligence infrastructure, advanced manufacturing systems, and renewable energy deployment accelerates further throughout the coming decade. The broader significance of the silver collapse ultimately extended far beyond short-term price volatility, because the event exposed the fragile psychological architecture supporting modern financial markets, demonstrating how rapidly investor sentiment can shift from extreme optimism to widespread fear whenever leverage, uncertainty, and macroeconomic instability collide simultaneously within a globally interconnected trading environment, dependent upon liquidity access and institutional confidence, while retail investors experienced severe emotional exhaustion after witnessing the destruction of previously celebrated bullish narratives surrounding inflation protection, currency debasement, and precious metal scarcity, causing many participants to abandon long-term strategic analysis entirely and liquidate positions during peak panic conditions, even as professional commodity desks increasingly focused on deeper structural indicators such as physical inventory resilience, sovereign accumulation behavior, industrial procurement activity, derivatives, market concentration risk, and monetary policy expectations, because experienced institutional operators understood that the ultimate future of silver would not be determined solely by technical charts or sensational media headlines, but by the complex interaction between global industrial necessity, mining supply limitations, geopolitical realignment, reserve diversification trends, and the long-term credibility of fiat monetary systems themselves, factors that ensured the sudden crash toward $76 would remain remembered as one of the most psychologically significant and strategically important commodity market events of the modern financial era.